Welcome back to Cheche. We're live on Citizen TV. Not for the first time in Kenya, there is an attempt to cap high interest rates. As Minister of Finance, President Uhuru Kenyatta was opposed to a previous attempt back in 2011-2012. So has his thinking changed since? Court leader Raila Odinga thinks it should have changed and has asked the President to approve the legislation. Well, today's guests are Habil Olaka, the CEO of the Kenya Bankers Association, and Anzetse Were, a development economist. And they're both opposed to the legislation. But Anzetse, I'll give you the opportunity to qualify your opposition to the amendment bill.
Exactly. I think the reason why the capping story shouldn't happen is because I know that the access people have to credit and loans will go down. As a development economist, I don't like high interest rates, trust me. But I do know that given the priorities that the banking sector has, that availability of money will begin to dry up for those small businesses that need that money the most. And that's why I'm saying Kenya should also start looking at other types of financing so that the banks don't even need to look for loanees. People are lining up to go to the bank. But there are other people.
On the contrary, banks have been hawking loans.
No, but I think, I don't think they've been hawking loans. To certain demographic groups, yes. To the demographic groups that they think will repay the loans, yes, but not to the mama bookers necessarily. And that's why the mama bookers do the table banking, the village banking, and this informal financial sector.
Okay.
So.
I don't agree with you at all because you're arguing that banks will stop. Once the law is there, and the people cannot, where will they take their money?
There are other options. We'll go back to that old model you were complaining about, where banks weren't trying to help the common mwananchi.
Okay. Habil, would you accept that this banking amendment bill has to do with the failure of banks to regulate themselves in the interest of the public?
I think the issue of self-regulation has been there for quite some bit of time, and as you must have noticed, the Kenya Bankers Association came up with a self-regulatory framework, which is work in progress, arising out of challenges that you've had in the banking sector. So the self-regulatory framework is actually something that you're trying to put in place. It's work in progress, and it will certainly start bearing fruit as we move on. But coming back to your question, I think the issue is what impact will this bill have on the banking sector, if at all it's passed in its current form?
It has, and it will be assented.
Well, it's now at the assent stage.
Yes.
So if it's assented to, what impact will it have on the banking sector? You know, as Anzetse was saying, what then happens is that banks will not be able to lend to borrowers whose risk profile is, above that.
Let me interrupt
you. So what then happens? Yeah, what then happens is that the high-risk borrowers will be excluded from the banking sector, and now they will have to look for funding from elsewhere, which means that they'll then be pushed out into the informal banking in the informal sector, which means that the informal sector will now start will be the ones that will be lending the money. On the deposit side, banks will not be able to pick money that they cannot be able to on-lend. So what will happen is that the depositors will now have to put money elsewhere. So now that's the money that now will be fueling the informal sector. So what are you talking about? The banking sector will actually shrink. Job losses will be there, because when you're shrinking, you have got to release staff. So job losses will be there. The payments that banks make to the taxman, by the way, we are paying quite a bit of money. There's almost 40 billion in terms of direct tax to the KRA. That now will come down because banks will not be remitting that money to the KRA. What happens? There's a shortfall in terms of the revenue that the government gets from the banking sector. The difference will now have to be gotten from borrowing onto the domestic market, which affects the T-bill rate as we speak. The economic impact of this, we can go on and on and on and analyze.
That is, to me, scaremongering.
It's not scaremongering.
Let me ask you this. When Credit Reference Bureau was introduced, you can know those people who are at risk. You told us that. How come those people who are not that risky, they don't benefit from the interest rate?
Oh, they are benefiting. They are benefiting. You see, with
the interest rate they pay is the same as any other person.
As the mechanism,
the only better advantage yes is you will get a loan quickly.
Yeah,
as the mechanism, it does not benefit by interest rate.
Okay, as the mechanism peaks, and as the Credit Reference Bureau firms start giving credit scores for individuals, banks start using that credit score to be able to risk price you as an individual. And then they say that you are a better borrower than her, for example. And therefore, I'm going to give you a 2% lower rate than I'm giving her. Once that mechanism starts becoming entrenched, we'll start seeing that differentiation between the respective borrowers on the basis of their credit scores.
Charles, before you wander, let's just hear from our Twitter public, and they're not with you. They're mostly against you, Habil. Banks, stop panicking. You're not interested in growing the economy. That came from, I'm not sure what the name is on Twitter, Waterclan Links. Saitoti Peter, banks don't want to lower interest rates as they make up 61% of banks' income. Hamudi Balala, Habil should just stop. No amount of explaining will convince us. Banks have been leeching the public for ages. It's time it's stopped. Dismas Agola, our banks are operating like Shylocks because they abuse the market imperfections. Ishmael Neribo, the president should sign the bill into law like this morning. So how is it that in spite of all your explanations, the innovations that you talk about, the new products that you're talking about, that you have so alienated the public?
I think one thing is that I think we need to get this into perspective. Are the rates in Kenya high? Yes. The rates in Kenya are actually high. And that we acknowledge. I think we need to accept the fact that the rates are high. They're not sustainable, they're high. But I think the solution that is being prescribed for the problem is where we have got a difference in terms of opinion.
Why can't the bank
how do we bring the rates down? I think for you, the way you're putting it is like, you know, we have got just one cut solution. Pap, you know,
the rates high, people want them low.
Now, yes.
What are you doing?
What are we doing about the problem of bringing the rates down? And I'll give you a number of initiatives that have been put on the table, which are actually beginning to bear fruit. For example, when we talked about having a common reference rate, the Kenya Bank's reference rate, which was introduced in July 2014. Between July, the KBRR, when the rate was introduced, the rates in the market then in July 2014 was about 17%. Within 1 year, to July 2015, the rates had moved from 17% to 15.5%. That's almost a 1.5% reduction in the rate.
And now?
Now, what happened between July 2015 and the end of the year, you all know, there was the macroeconomic volatility in the market. Inflation went up. The T-bill, for example, moved from 8% to 20%. That destabilized the market. And so the trend that had been developed due to the KBRR was reversed. So by the end of the year, the T-bill, the lending rate actually had moved from 15.5% to 18%. But subsequently, there's now stability. And so we are again seeing the trend beginning to go down. So the KBRR, by its own introduction, by the way, has been working. And I think we need to give it time for it to continue delivering the benefits. The other thing,
how much more time? Okay, make your point.
Was the CRB, the Credit Reference Bureau. I think the Credit Reference Bureau mechanism is bearing fruit, but we need to give it time as well to mature. Because you remember where we started from. Initially, we obliged banks to share negative information.
That one you explained.
Then positive information. Then we got in other credit providers into the mechanism. Once you have got the full picture of the borrower, then now this mechanism will start delivering the fruits to the borrower.
How much time? How much time?
Where the bank can be able to use credit score of the individual.
How much time? Because this is not the first time we've tried to cap interest rates. It goes back 15 years. We tried again in 2011, and we're trying again. So something isn't. Yes.
I think
something's not working.
And I think the thing is this: that the whole debate about bringing the interest rates down is not just on the banks. I think there are a number of stakeholders that have got to play their role as well. She talked about the government, for example. In terms of the T-bill market, the fiscal policy has got to get their act together. Because the T-bill rate, for example, drives the rates in the market. If the T-bill goes up, will banks just not respond to it because they are picking deposits at a higher rate? They have got to transmit that onto the borrower. You see, so the fiscal policy side has got to get its act together. That's one. Then the other one is we are talking about the CRB. CRB, I think we have we're getting our act together, and the benefits will start slowly being transmitted to the market. The other thing is operational cost structure. within the banking sector. And what we're talking about here is, can we have banks leveraging and beginning to share infrastructure, what you call interoperability. And there's a lot that's happening in that area. We have got, for example, the check truncation system that was introduced by the KBA, that the benefits are being transmitted onto the consumer. We are currently working on a switch which will enable banks to be able to, on a 24-hour system, real time, be able to transfer, transactions. Once that switch comes into place, the cost of transacting between the banks will come down, and the benefit of that will be transmitted to the ultimate consumer. And there are many other initiatives that the banking sector is trying to work on to address each of the specific areas where the banks are beginning to, or rather they are feeling that the effective cost is being transmitted onto the
Let me come to the panel, actually.
For example, the land registry.
Are you saying the common mwananchi who suffers the most because of high interest rates has absolutely no role, because you've counted the banks, you've counted the government, you're saying, and others? Does it mean me who suffers most have no role at all on the issue of capping interest rates or moderating interest rates?
Now, where I think the consumer comes in is what you talked about, the CRB. Because when you when you have a credit profile that shows you are a good borrower, and you stick to that, and you can then be able to demonstrate that to the lender, that will enable the lender bring your rates down. So I think we as borrowers as well need to create that profile, that track record that shows you're a good borrower.
Okay.
Udwa, I was wondering, and you stopped me from wondering. Please let me wonder.
Okay, wonder.
And the presidency has time and again talked about ensuring that interest rates are lowered. I know you're not speaking for them. You may be.
No.
What do you think they have in mind as a development economist? What does the presidency have in mind?
Well, that I wouldn't know, but all I know is that their fiscal behavior is diametrically opposed to any proclamation around reducing interest rates. If you remember the Eurobond, one of the biggest arguments the government made for us going into the Eurobond was that we'll bring down interest rates. The domestic pressure for credit in government will go down. Did that happen? No, it did not. So there's some part of government is talking about interest rates being lowered, but the way they behave in terms of their financial behavior actually does the opposite.
Okay. So now I want to come to you, panelists, and this is what our viewers are saying. The President should assent to the Banking Act Amendment Bill to control the banks. Kenya is the only place where such bank profit exists. Hold that thought. Remind the bankers that the oil industry is oligopolistic in nature, but pump prices are controlled. And so, again, the public is not with the banking industry. Do you think that, A, this bill will pass? Do you think?
May I say something?
Yes.
This bill must pass.
It must.
The way he is talking, it makes just the same argument. It's the reaction of this bill. That's why they are bringing new things, new innovations. If it were not for this, they would just remain the same. Remember, banks used to refuse savings less than 10,000. Remember, after other developments, banks now came in the streets looking for teachers, looking for to lend money, hawking loans, and trying to open as many. They employed many children, school leavers, to try and convince people to open bank accounts. When this bill is passed, they will do the same. They will find that they are not lending any money to anybody, so they will come back down and agree. They will agree. They will have no choice but to agree.
It's a rather tricky situation, but from where I sit, this bill needs to pass. We need to have a situation. We need to have a situation where, because the banks have refused to regulate themselves, or if they do, it's not affecting on the common mwananchi. Somebody needs to knock their heads, bring some sense into it. Then we can go back to what she was saying. We have had situations, Zambia, West Africa, I think Latin America, where such caps were put just to make sure that everybody gets sane, and then you go back to a liberalized market. I don't know, but in my opinion, banks have run amok. They need to be controlled.
Okay, Habil, in fact our viewers call you rogue. And Charles says that your heads need knocking, and that hopefully this bill will become law and will achieve some sense.
I think we are in agreement in the sense that we are saying that the rates in the banking sector are high. I think where we are not in agreement is how to bring them low. And I think I've tried to elaborate on measures that you have put in place to ensure that the rates come down. And you know, you mentioned the fact that is a reactionary kind of thing. But KBRR has been with us now for 2 years. It's not a reactionary thing to the bill. It's something that was put in place because of the concern then. We put in measures and they are beginning to bear fruit. CRB has been around from 2009 when we started implementing the mechanism. The fruits are beginning to be born, you know. So
remember, there was not
the point I'm trying to say. That is what the point I'm trying to say is that a number of measures have been put in place, not just by the banking sector, by the other agencies of government. For example, in terms of, for example, digitizing the land registry, because you know most of the banking sector loans are actually collateralized on land. Digitizing the land registry is a critical component of it to make it more efficient. That already is happening, and that's an initiative by the government. So there are various initiatives that are coming into place to ensure that the whole framework is facilitated to bring the lending rates down. And it's not just from the banking sector. Central Bank, for example, has been doing quite a bit to try to facilitate the banks to bring the rates down. As you are aware, Kenya Bank's reference rate just about a week ago was brought down from 9.87 to 8.9. Banks have immediately responded because a mechanism that is put in place to ensure that all banks price their loans on a common reference. So when the rate came down by 1%, all banks have given a notice to their borrowers that the rates are coming down by 1%. Isn't that working?
So if you are threatened, you act.
Yeah.
That means if you are killed, you will act more.
It's not a threat. It's a mechanism that was put in place. Central Bank at its monetary policy committee brought the rate down by 1%. It's a mechanism that is put in place, so banks respond immediately. The rate has come down by 1%. This is the pricing mechanism we have. We also bring the rates down by 1% in response. So it's not a threat per se.
Right.
The mechanism that is put in place.
Panelists, I'll come back to you because this is the third time now this bill is coming up. Donde tells us that nothing, not even a comma has been changed, but twice now it's been rejected, and some would say due to the very effective lobbying by the banking and financial industry. Do you think that this time the banking industry will get their way? You said that it needs to pass, it must pass, but Habil here has been putting up a spirited fight against the bill.
One thing is this time around we are seeing a convergence even in Parliament. In the other previous 2 occasions, there was a little bit of opposition, and so the lobbying by the banks was more effective. They were able to penetrate. But this time around, we could see a convergence in the opinions of the members of Parliament. And this, and being a pre-electioneering year, I see things.
The Jubilee government promised that they won't.
I think it's a risky gamble. I think putting a cap on interest rates, given the way the reflex banks have, it's a risky gamble, I think, for Kenyans. And I think that would be my position.
Life is a risk.
Where will they go?
I'm not saying that.
Where will they go?
They'll go to the informal markets. They're there. They'll go to informal financial providers. That's what will happen.
Habil?
Banks?
Yeah, and I think the consequences are quite clear. Banks will simply contract, lay off staff, and then the lending now will move.
But they'll find other jobs.
Yeah, I mean, and then the lending will move into the formal market.
I think Habil is behaving like a preacher. If you don't repent and get saved, you will go to hell.
How many times, not because of interest rates, have banks sacked massively? Massively. Laid off people. Not because of interest rates.
Yeah. They are laid off every day and night.
I had a sister who was working in the bank. They were laid off by, I don't want to say the bank. This is not the first time, and it won't be anything new.
Yeah, I think the way forward is this. We all agree that the rates are high. I think we also need to agree on how to move forward in terms of how do we bring the rates down. What you're saying,
but the president has said
not a solution. This bill is not a solution. The solution is to identify the areas
it could be temporary.
Why the rates are high, and therefore tackle each one of them individually. Like, for example, we mentioned about the T-bill, you know, the fiscal policy. What can we do about that to ensure that there is stability, and therefore the rates are not, you know, we don't have these spikes? What can we do about, you know, transparency in the banking sector to ensure that the consumer has got the power to be able to differentiate between different banks and be able to move a facility from one bank to the other? You play off each bank, one bank against the other, and therefore banks are able to compete on price. Because you see, that is not happening.
Panelists,
and that needs to happen.
Panelists, before we wind up, a quick question, and this has been brought to our attention. It was remiss of me not to mention it, actually. My fear is the president has an interest in the banking sector he might not sign, and that, of course, has to do with the Kenyatta family and the expansive business interests, which includes banking.
Of course, that makes the president, if he's interested in contesting again, have to work even harder to convince the Mwananchi, to whom he had made a pledge to lower interest rates. And again, I must add as we wind up that these laws are not cast on stone. Use it to bring sanity.
Temporarily.
Go back to Parliament. Let them change it. What's so hard? If it causes inflation, like she threatened.
No, I didn't say that. You misunderstood me. What I've been saying is that banks will contract lending. That's what I've been saying. Yeah.
And I'm saying banks will contract lending temporarily, then they find they have nowhere to go. They'll come back to a 90.
Okay.
They did that. They did that.
Okay, fine. And so that's where we'll end Cheche this morning. I'll thank our guests for their time and for explaining their positions. Habil Olaka, the CEO of the Kenya Bankers Association, and Nzetse Were, a development economist. Thank you for the Economics 101. We'll also thank our panelists, Mutegi Njau and Charles Odhiambo. Thank you very much for watching and engaging with us. My name is Udra Kamimo. We'll see you next week.